Hello, everyone, and welcome to Emerald's webinar series. Thank you for joining us today. I'm Mark Schlegel, and I head up Emerald's institutional client service and business development team here. And I'm going to be the moderator of the webinar today. So what we like to do on these webinars is really delve deeper into a topic, maybe a current or relevant investment theme that's out there, sit down and have a conversation. So we invite someone from our investment team that covers that sector or industry, invite them over, we have a conversation so that we can learn a little bit more about that topic. Today's topic's one that's been in the news quite a bit lately, and that's crypto. So the title of the talk today is Beyond Crypto, Decentralized Finance, and the future of the banking industry that's out there. So, and the guest of the day is Steve Russell, my colleague here at Emerald. Steve, welcome.
Thank you, Mark.
All right. Glad to have you. So Steve's a portfolio manager here at Emerald. He's also a senior investment research analyst. He's been with the firm 19 years. He's been in the industry 25 years. Steve covers the banking and financial services sector for Emerald. And really, he's our go-to expert in-house for all things banking and financial services.
I think that's the first time you called me an expert.
Always, every day I call you an expert. So he's been really researching the sector for a couple of decades now. He's got a vast resources of contacts that are innovators and leaders within the sector that he can pull from. And one of the things that's interesting and relevant to what we're going to talk about today is that over the last 3, 4, 5 years, he's been doing intense research related to cryptocurrencies, blockchain, decentralized ledger technology. I always mess up on that. You got it. Decentralized finance, and really trying to figure out how all of those things are going to affect the banking industry in the future going forward. So that's really the basis for the conversation that we're going to have today about all of those issues. Right. So I really can't go a day without seeing on a TV interview about cryptocurrency, a newspaper interview about cryptocurrency, and my favorite, a tweet from a not to be named famous person about cryptocurrency.
Who would that be?
We can't say who it is, but I think we all know who it is. So it's a hot topic. It's really garnering a lot of attention. But one of the things that I think is interesting that you've said to me all along is that you think people are really missing the bigger picture issue about this. It's not about cryptocurrencies, but it's really about this transformational technology behind the cryptocurrencies that could be changing the way we do business every day, the way we live our lives. So if you don't mind, I'd like to start with that sort of a bigger picture question. And on one of your recent research white papers, you said, bank is not a place you go, but a thing you do. So can you start with that and explain what you mean by that?
Sure. So, in the past, like a decade ago, even, more recent than that, we didn't have our checks direct deposited to the bank. When you used to get your paycheck, you drive to the bank every week, you'd go in, you do your banking service, you knew the people inside of the bank. And doing that, the relationship was built. You got to know some of the lenders in the bank and things of that sort. That's not needed anymore. No one needs to go into the bank every week to deposit their check.
So I'm the only one going into the bank every week.
You're the only one going in every week. And as the financial technology has evolved, there's really no need to go into the bank to request a loan. So you can refi your house without actually walking into the bank. I will dare say I've got 2 boys in their 20s. And I don't think either one of them has ever walked into a bank branch, and I don't think that's going to happen. There's still some folks that go to a bank and want to talk to a lender now for a business loan, but I think those days are coming to an end as well. And I think the pandemic has kind of sped up, I should say, the adoption of technology. So I think we're getting to the point where you've got these payment apps on your phone. There's all kinds of different financial services apps on your phone. And I think that, those wallets and those financial apps will become the main point of your banking services in the future. And, for me, I don't see that there's a reason to actually go to a physical bank. Everything that you do at a bank physically, you can now do via technology on your cell phone or on your laptop or your iPad. It's not necessarily to actually have that physical interaction walking into a location. So banking is something that you're going to be doing, but you won't go to a bank to actually do that in the future.
So if your sons at 24 and 25 aren't going to the bank, younger generations won't even know what a bank is.
That's
a physical bank.
That's where I think we're going. And as those, mid-20 folks start to become business owners and the like, they don't want to, spend the time of, I've got to schmooze, because believe it or not, it's actually kind of reverse. Instead of the business lender schmoozing you're going out with them and you're trying to get this guy to say, okay, I'll give him a loan because I believe that he has the ability or the desire to repay this loan. But with artificial intelligence and things of that sort, those things are more efficient and less time consuming. And that's just the way people think now. And there's no need to spend that much time having that much personal interaction to get the same business done. I refied my house and never met anybody. It was all done online. I got approved in less than 20 minutes. It was a great experience. And, doc, e-sign and things of that sort.
Right.
It's really changed how you can do banking.
All right. Thank you. That's really interesting. So next question. Cryptocurrencies get all of the headlines, but can you talk about decentralized finance, which you mentioned,
right?
Distributed ledger technology, which I got right that time, and really how it's transformational or could be possibly transformational in the banking and financial services industry?
Yeah. So distributed ledger technology is actually the backbone of this whole movement, whether it's cryptocurrencies, decentralized finance. Most people talk about DLT or distributed ledger technology as blockchain, but blockchain is actually just one type of a DLT. There's other types out there that are being used currently, and there's other types that will be adopted in the future. But what that allows you to do, and what we refer to as decentralized finance, is the ability to do financial transactions over a blockchain using smart contracts. So there's no centralized entity that needs to be in the middle of that transaction. So if I'm a business and I want to borrow money, I could actually borrow that money from anybody using, a decentralized technology, a decentralized finance and DLT to actually complete that transaction. So, within that smart contract, we would set out all of the rules or points of that contract, and then that blockchain would actually it would actually keep track of exactly, okay, here's the interaction, here's the transaction, and everybody on that node verifies that transaction. And it's a transaction that we know has been verified between these two sources. And then the smart contract is sitting there on top of it with the details of that transaction.
So some players may go away and other players may, new players may come into this ecosystem, which we'll talk about in a second, the ecosystem.
Right.
All right. So far we've kind of danced around cryptocurrencies. We haven't actually talked about them. And I know that one of your pet peeves is crypto, or the use of crypto and how loosely people use crypto. But just for a second, if you could talk to the folks about what actually are cryptocurrencies and how they're transforming how we pay merchants, but also how we may transfer money to one another.
So cryptocurrencies come in many forms. And the reason why I have a hard time with when we focus on cryptocurrencies, because in the public and in the media, people kind of paint cryptocurrency a certain way. Crypto is just referring to cryptology. Cryptology is used to actually verify transactions on a blockchain, whether it's a financial transaction or some other type of transaction. So that's where the crypto comes into. The currency part, like I said, different tokens that are out there, Some are considered more used for currency. Some say store value for other things. And then there's other type of tokens that are out there as well. And there'll continue to be more. Crypto and blockchain is also used for NFTs and things of that sort, non-fungible tokens, and there's fungible tokens. We won't go into all that.
That's way too much. We don't have enough time for that.
It is important to be able to, the use of cryptocurrencies. It's very important in that, you cut down on the amount of time as far as settlement when you're doing a transaction. So cross-border settlements have been one of the first applications that we see really the difference that it can make. So, if you use the Swift payment method, they actually batch the transactions, and those transactions actually don't settle real time. But if you're using some sort of cryptocurrency, that transaction is actually completed real time on the blockchain, and it's verified. So, if you look back over history, double entry accounting was key to actually building out trade back in the 13th century is when double entry accounting actually started. And a lot of people refer to this now as triple entry accounting, because you're still doing the accounting where one entity has the transaction on their records, another entity has a transaction on their records, but now there's a third party that's verifying that transaction, which are the nodes on the blockchain. And actually, that knowledge is out there publicly and verified by a third party. So think about like auditors. Auditors would go into one institution and say, okay, well, we're going to audit the transaction on your side. And then another auditor would come into another business and audit the transaction on another side. Well, if all that's public and out on the blockchain, which really that audit can happen a lot faster because it's there, it's verifiable, and it's public, it's open to the public. So, I kind of got sidetracked and made that a longer answer.
No, that was good.
But, transaction tamper. Think about trading stocks. Why do you need to have a central exchange in between me buying and selling a stock? And it takes 1 to 2 days, 3 days in some cases to settle that trade. If you're trading using cryptology, it settles real time. And you don't need a centralized entity in between that trade. If you want to sell your stock and I want to buy it, we can do a trade directly without needing, a middleman in between.
So you mentioned something about cross-border transactions, and without mentioning specific companies, there are companies now that are already using blockchain technology internally to do
Correct.
Those cross-border transactions. And they're happening real time. And are they their own blockchain technology, or there others? What?
So there's all the above.
Okay.
So there is public blockchains that are out there, and then private blockchains, and there's companies using both right now. The public blockchains are more decentralized and are verified by other entities across the world, and according to how many nodes it can be verified by hundreds or thousands of different entities verifying that. And then there's also private ones that are, there's some older institutions, not naming names, that are in the banking space that have some private blockchains that are out there that they've created that function the same way, except you don't have the third party verifying, or multiple third parties, I should say, verifying the transaction. But they have been used for years now. And there's actually more usage of blockchains and decentralized ledger technology than most people think going on right now. And a lot of people don't even realize that it's occurring.
Is the benefit for those companies speed of the transaction, verification? What's the impetus for that?
Speed of the transaction and verification, but it's really speed of the transaction. So if you have a kind of a closed loop private blockchain, and that's how some of the older institutions have started utilizing it. And you've got two parties that are both in that network. They can trade back and forth and settle, like I said, real time, without needing to, have that delay of, okay, we're going through Swift and we batch it. And then,
even though it's an intra-company transaction, they still have to go through Swift and all that. This way they are able to do that internally.
Yep.
Okay. Interesting. All right. So one more question before we get to our audience questions. So are there ways to gain exposure to this transformational technology other than cryptocurrencies? So I'm thinking sort of ecosystem of decentralized finance. I'm sure there's different types of players.
Yeah.
Without talking about specifics, or our compliance folks will shut down our webinar or not let us record it. So, but if you could talk about that, so how investors can sort of gain some exposure without actually buying the cryptocurrencies.
Sure. So one of the great ways, it's the old saying, we're gonna buy invest in the guys that are providing the tools.
Okay.
Whether
picks and shovels.
Exactly. I was going to go back to the old picks and shovels.
Right.
And so there's plenty of opportunities out there for that. Right now, a lot of the work that's being done still has some type of centralized entity involved. So, if you're going out and you want to trade cryptocurrencies, for instance, right now, most of that is being done on some type of centralized exchange. There is a way that you can do it on what they call a decentralized apps or dApps, but most of the people, retail investors as well as institutional investors, are using some kind of centralized entity. So there's exchanges that are out there. There's merchant banks that are out there that are providing services for institutions. And then, like I said, obviously there's folks building out technology on top of blockchain and using it for other purposes as well. Agriculture, tracking ag, things of that sort.
You talked about seeds, from tracking seeds.
Seed to sale. Yeah.
Seed to sale.
Yeah.
And they're using that technology to do that.
Correct. Yeah. So, just think about every time we have an E. coli outbreak and they're trying to figure out, okay, what lettuce producer did this come from? If you actually were using blockchain, that'd be a simple solution to figure out, okay, where did this lettuce actually come from? Because you can track from seed to sale.
Interesting.
That crop.
And that's out there and a lot quicker to get that information.
Correct. Yeah. It's public knowledge.
Okay. And so some of these exchanges and things out there, so they're really benefiting just from people trading those cryptocurrencies. They're not betting on the value of those cryptocurrencies.
Yeah.
So they're making money just on the transaction.
Yeah. So that's been the interesting thing. So some of the exchanges that we're invested in, when we saw the price of certain cryptocurrencies going down over the last couple of months or so, or last couple of weeks, you also saw the price of those exchanges going down. And you hear people say, oh, well, XYZ currency is down. So, that's why the stock's down. But that's actually the interesting thing is the volatility, just like with any other exchange, volatility is good for them. So, for them, it's a transaction, there's more volume.
Okay.
And at times, those that are actually making money on the spread with the volatility, there's also opportunities to utilize or take advantage of bigger spreads as well.
So as that adoption happens with cryptocurrencies, more and more volume is going to be happening on these exchanges. Therefore, these businesses theoretically should be growing.
So what we've seen is you see active users, the active user number increases. When I say active users, so people will sign up, but we're looking at is the active user and actually people actually fund accounts and actually make a trade. So we've seen a huge spike in active user accounts. And then also, if you look at the average funding, so the amount of money that's actually funded in an average account is been growing as well. And so that's the exchanges have actually done extremely well this year as a result. And even with the volatility and the movement in price that we've seen, we're not seeing people actually take that money off exchange either. And there's other reasons for that, because there's ways to make interest on these exchanges as well. So, if you've got money on an exchange, even if you want to sell whatever currency you have, if you keep it in, let's say, one of the stable coins and you're making 6% interest or so, why would you take that money off that exchange and put it in your bank when you can make 6% or some type of interest?
Right.
Anything more than the 1 or 2% you're going to get at your traditional bank, why take it off exchange?
So when, and I understand your frustration then when people just talk about cryptocurrencies and really not the overall ecosystem and what's happening. You mentioned, just one last thing before we get to the audience Q&A, you mentioned, merchant banks and things. There are, it's just not new companies that are doing this. There are a lot of existing bank chartered community banks and others that are utilizing this technology, right? So it's just not for new companies.
Right. Yeah. So far, there's been a handful of banks that have really dived and gone deep down. We call it the rabbit hole in the area, and they've been benefiting from extremely cheap deposits by being involved in the cryptocurrency ecosystem. But there's also, there was a big announcement by one of the core banking providers and talking about how many new banks that they're onboarding, and they had over 100 smaller community banks actually in the pipeline for onboarding a technology that would allow them to make different currencies and trading cryptocurrencies and things of that sort available to their customers. So that's been one thing, and then you also have other institutions that are looking at creating products. There's hopes that there'll be an ETF down the line. So you've got some of the traditional institutions that have submitted applications for ETFs and things of that sort and playing in the space. And then there's other ones, some of the kind of mainline big name folks that are already making it available to high net worth individuals.
Okay. All right. So I think it's time to switch over to the audience Q&A because I think I've given you some easy questions, but I'm sure the audience is going to throw some difficult ones at you. So Damien, if you're there, if you want to take it away for the Q&A of our audience portion.
So we have gotten a lot of questions from the audience. We haven't talked about it yet too much, but could you talk about the idea of a smart contract and how a smart contract works and how that kind of integrates with different cryptocurrencies and transactions using cryptocurrencies?
So we touched on it slightly. So you've got your transaction that happens on the blockchain, but the underlying rules of that transaction are actually put on top of it. So it's a second layer application. So your blockchain, let's call that layer one, and then the layer two application allows you to actually put on top of that layer one transaction that just verifies the transaction other contractual obligations between the entities creating that transaction. And so, that information is actually built in with code on top of that layer two that specifically defines how that transaction and how those two entities are going to work that transaction from beginning to end and what the rules are basically within that transaction. And then it's out there verified. So, as you go down that path, that's what allows you to not need a centralized entity, whether it's a bank or some other institution telling you, well, here's what your interest rate's going to be. Here's what your terms of the loan are going to be. All that's done within code and is placed on top of the blockchain. That's clear to each entity. And obviously, when that's not fulfilled, then that's when you have the repercussions of whatever is placed into that smart contract as well.
So we've gotten a lot of questions here on DeFi and how DeFi is actually kind of making its way into the traditional banking system, and not only on products offered from banks, but some of the kind of digital platforms and ways for clients to interact with their banks. Can you talk about what we're seeing today in terms of new developments that banks are coming out with that include DeFi? And maybe you mentioned ETFs and other products that banks are coming out with that kind of incorporate DeFi, but just a little more about how it's getting into the traditional banking system.
Yeah. So just to clarify, and there's going to be different stages of adoption of decentralized finance. But the definition of decentralized finance means it's not happening at a bank or at a traditional institution. So what we have now are decentralized like financial services that are being conducted still using a centralized entity. So we're not quite there yet with the mainstream. There are, like I said, decentralized apps where you can go out and you can do everything from borrowing to you can be the lender to, providing other financial services to people that do not use a centralized entity. But right now, most of the comfort level with people is more so of, okay, there's an application or there's a bank that's involved here, and I can get and I can go at it that way. So what you'll have is someone who wants to let's say provide leverage to an entity. They'll go out and say, okay, I've got this amount of money or this token that I'm willing to lend, and they'll have a centralized entity, whether it's an exchange or some other entity that provides that service and connects you with someone on the other side that wants to borrow or wants to put leverage on their transaction. So there's still a centralized party there, but those type of interactions are going on. But you can do it without a centralized entity. Most people just aren't comfortable with that quite yet.
So this is another question from the audience. I've actually gotten a couple of these. I think it's very timely, just given the events that have happened in the last 24 hours. But we've seen the U.S. government was actually able to seize part of the ransom that was paid by Colonial Pipeline to the hackers that demanded the ransom. Can you talk about any concerns that might have developed from this recent seizure, and if this leads to any benefits or negatives to the cryptocurrency and blockchain technology space?
So, we there's the term FUD, fear, uncertainty, and doubt. And we see that every time there's a news headline that says someone's wallet got hacked, or Bitcoin got hacked, or this exchange got hacked. And so the blockchain has not been hacked. And that has not been the case today or yesterday. What occurred was, or what we believe occurred, was that the U.S. government did two things. One, because all the transactions are on the ledger, whether it's blockchain or whatever, they're on a DLT or blockchain ledger. You can actually follow those transactions. So when you know that payment's being moved, you can actually look out. There's ways that you can analyze the chain, and you can look and see those transactions and where they're going. There's public keys that you can follow. The part that's interesting is that they were able to obtain a private key. That private key actually allows you to access the actual value of that cryptocurrency. So, they followed that chain, and the hackers actually made a mistake. They were moving from one entity to another on decentralized apps, which allowed them to do that where the government couldn't confiscate any of the tokens or the currency. But what they ended up doing was actually, we believe, going to some type of centralized entity here in the United States, where the government obviously has jurisdiction. Whether it was an exchange, we don't know. Some people said that they rented a server, a third-party server, but at some point, those currencies went into a decentralized environment, which allowed the government to have access to that, whether it's on exchange or whether it was a server, to have access to that. We also believe that they hacked, the hackers, and were able, like I said, to come up with one of the private keys necessary to access some of the currency. So we think that they recovered about half the currency, or maybe even a little more of that as a result. But so that's the blockchain actually wasn't hacked. We don't believe, but instead, they were able to hack the hackers and come up with the private key, which is essentially the password, which allows you to access the currency. And then those hackers made a mistake of going to some type of centralized entity as they were moving that money from one location to another.
So a win-win. They hacked the hackers, got money back, and
Correct.
it wasn't blockchain that was hacked.
Correct.
Okay.
There's a few questions here actually on regulation, and people are just looking to see your opinion, Steve, on where you see regulation impacting the cryptocurrency or digital asset space, and you think that will be positive or negative long-term for the entire sector or industry?
Yeah. So that's an interesting question, and I'm going to give you kind of a 50-50 answer. I think the adoption of regulation helps the adoption of blockchain and cryptocurrencies by institutions. And I think that it helps further that adoption or speeds up that adoption. Actually getting to decentralized finance, I think regulation makes that more difficult in the fact that regulatory entities are always going to lean towards what they know. So they're always going to want to try to keep that centralized entity in the mix because they can control that entity. So it makes it harder to get to a truly decentralized, fully decentralized marketplace or decentralized finance opportunities. But I think it's a starting point, and I think it's an important starting point. So we think it's coming, but it's kind of it's good and it's bad. Like I said, it speeds, helps with adoption from institutions, allows for adoption by institutions. But, regulators, it's kind of like, why would you regulate yourself out of the power to regulate entities? So it's hard to say that, regulators are ever going to make it so that you have a truly decentralized finance system. It's kind of interesting. Like, we can do IPOs now without the technologies there. You can actually do IPOs of securities on a tokenized basis, which would allow us to trade 24/7, 365 days out of the year with real-time settlement. But, those large banking institutions that do all the IPOs and make all that money, that have all these, all the folks that they give to politically, are they going to allow that to occur? They're definitely not going to allow it without a fight. So it is interesting, and it's good, but it's also going to slow truly decentralize the adoption of a fully decentralized system.
Okay, thank you. So this is, I think I got time here for a couple more questions. Here's a question from the audience: is that it seems like Bitcoin and other cryptos, aside from speculative investment, were originally used for criminal activities. Come a long way since then, but do you think that there's any chance that Bitcoin becomes illegal, or do you think it's solidified its legitimacy in the world at this point?
Yeah, so I'll start with, it's always interesting when people start with the criminal aspect to me, in that, nothing's used more than the US dollar for criminal activities. And it's been that way for years. So, people look at the headlines, and it's a great headline, but every year there's criminal activity that use the US. Every year there's banks, major banks. You look at the top 50 banks, and you can go down the list of all the banks that have paid hundreds of millions of dollars for supporting criminal activities. And you don't see it. You don't see as much information about that out there. So I'll start with that. The second part there, as far as it being accepted as a currency, it's interesting in that I think, that we have categorized it here in the U.S. Equivalent, basically, as with gold, or not even equivalent with gold, because technically gold could be seen as legal tender here, but that's a whole nother story. But the tax implications make it hard for it to be actually used here in the U.S. as a currency. But the announcement that we've seen recently with El Salvador talking about using it as a currency will be interesting, because if you get enough other countries that are using it as their currency, then that changes the ability of U.S. entities to be able to recognize it as a currency. And so that, I think, is an interesting thing that we're seeing play out now. And then you'll get the pushback as well. Well, it takes too long to, it takes 10 minutes before a transaction really gets complete if you're using Bitcoin as that central currency or legal tender. But there's other applications that can sit on top of that, layer 2 application that can speed up that process and things. But it's yet to be seen. But I still think there's a chance. That you mentioned the value. Some people say it's a speculative, that it's speculative. There's actually, I believe, there's a way that we value it. There's different models out there that you can look at, whether it's stock to flow. One of the things that I always focus on also is just, if you look at whether it's proof of stake or proof of work, those people that are verifying transactions out there on the blockchain are actually paid in currency, in whatever cryptocurrency typically that they're verifying transactions for. And so the more transactions that occur, that's how you're getting additional tokens added out there as well. And so that actually comes into valuations as well. So there's ways to value things out there, the different tokens out there. It's much easier, obviously, if there's a limited number of specific tokens available. But those that say it's speculative, there's actually valid ways of valuing, and it's ways that we valued other, whether it's gold or other commodities. There's other models that have been used historically as well.
Okay, thank you. So I think we have enough time for one more question from the audience here. So institutions have started to allow certain clients to invest in crypto. You feel like many institutions have been cautious about this, mainly due to custody issues, but can you talk a little bit about how this has evolved and where you see that concern going in the future?
So, with decentralized finance, it's been interesting in that, like I said, we talked a little bit before about different exchanges being hacked and things of that sort. And you always hear the whole term out there, not your keys, not your crypto, and you have to be careful about how you custody things. There's a lot more institutional custodial options available now. The OCC last year made it so that banking institutions could provide custodial services. And we're seeing more and more of that occur. So, and that's where, if you look at how adoption is going to happen, it's by methods that people are accustomed to or comfortable with. So, an institution that wants to buy cryptocurrencies, when you trade stock, you don't usually custodian, or you don't use the custodial services aren't with the exchange that you buy your stock from. There's usually a separate custodian relationship. And now we have the institutions in place that can provide that service. And it just gives you have a familiarity and a comfort level there for institutions with those type of transactions. So I think that has helped with the adoption by institutions. And I think that it will help continuing moving forward, that you have two separate entities there, the place where you actually do your transaction and the place where you can custodian those tokens. And there's also insurance available now. So, you can actually have those tokens custodied someplace and then have institutional, insurance from large insurance institutions on those deposits.